Roman Scott, our economic spokesperson. Thank you.
I hope this, oh yes it is on. I'm very sad to hear that I'm only a little eccentric. It's the Irish blood, you know. I had no idea we were going to be in an old Parliament House today, which I think is a very appropriate venue for what I'm going to talk about, which is the definition of what is called in the market political risk this year. For those of you who are poor, unfortunate investors and ordinary people who've had to suffer from it, I don't call it political risk, I call it gross incompetence, stupidity, negligence, various other things. So I'll be saying a little bit about what has been going on. My understanding of the group today, and one of the things I'm usually asked to do, is to try and explain economics, macroeconomics, and global macro for a non-professional, non-economist audience, and try and make it a bit more fun, but also help you guys understand what's going on. It's been very confusing, so I'm going to try and do that. I also have had, the last couple of sessions, I've heard some feedback for those who actually don't like missing the eccentricity part of saying, oh, the last couple of briefings, Roman, you've sort of toned it down a bit, and you've just focused on the economics and less of the jokes and less of the insulting, you know, various nation states, large and small. Don't worry, today I'm going to redress the balance. I am, for once, I'm actually going to be nice to the Brits. I'm not shy of attacking my own home country. I'm wearing my Union Jack cufflinks. You can see they're actually doing the right thing, and nothing being British, but the people we're going to pick on today are going to be the Germans. There's Germans of all shape and form and stripe, including certain Frenchmen who became German, a little bit too German, and then we'll go through the Greeks and the Italians and a few others. So first page. This is what I think I heard for the big issues. If you remember the first half of the year, when we started in January laying out the groundwork for the year, the message was actually there was too fast a recovery in 2010, was just a bit too much recovery, particularly in the markets, and investors were a bit exuberant, but there was absolutely no reason. Most reasonable economists, database looking at the data, thought there would be any grounds for serious worry. Recovery would continue. There'd be a bit of a correction, largely because things had gone too far. US was on course to slowly start coming out of funk. Slow, largely jobless, but recovery was on the cards. And the first part of the year, the markets were doing fine and reflecting that. And the economic data, there was nothing irrational in the data that would say anything other than that. So, of course, after the summer, we had a major meltdown, and things have continued to spiral out of control. A lot of people cannot work out what's gone wrong. If you are a normal investor who's trained to, you know, focus on economic fundamentals, hold good equity positions, wait for medium to long run returns, you've been absolutely pasted, and you're most probably wondering what's going on. There's been a lot of noise around, are we going into a double dip recession? The PMI data, which is the forward look of manufacturing activity and industrial activity, has not looked good system-wide, and it looks like the contagion effect is rolling even into emerging market Asia and high-growth areas like Singapore or like China. Apologies for starting without the House of Lords hearing, but since the House of Lords are usually deaf, it doesn't really matter too much. I'm not going to comment on who I can actually see sitting in the House of Lords.
Yeah. You only missed about 10 seconds.
So unusually, I'm going to start with the markets. And as I said, normally as economists, we don't really care about the markets. I don't believe the tail should wag the dog. But what shouldn't have been a bad year for equities, and what nobly forecast to be a bad year, particularly for you've got the more fast-growing emerging market stuff over here on the right, the developed markets on the left. And we were expecting a slowdown from last year's strong recovery bounce, over-strong recovery bounce, but we weren't expecting a picture like this. And if we flip to the next page, even with a little bit of recovery bounce since the so-called announcement of a solution to the Eurozone crisis from the G20 meeting. Markets have crawled back on average by about 6% across the board, but most of you, if you're in equities all year, are still not looking good, particularly if you're in the high-risk market, emerging markets. Notice what's going on. If you flick back between this page and the last page, right, everything is correlated. The 6% recovery bounce is 6% across the board. It doesn't matter whether you're in high growth, strongly performing, going for a soft landing, no real issues, China, or you're in the FTSE or in the CAC. Everything has moved in one, which is, of course, what is not meant to happen. Diversification, portfolio spreads around the world, geographical and territorial and economic difference is meant to make a difference, but isn't. And I'll talk a bit about that later. So if that's the market position, let's look at my favorite lead indicator. I use Singapore. Singapore, as I often say, is a call option on the global economy. That's why I like Singapore. The blue line is Singapore. The red line, these are done to different scales, is the economies of the top G7, basically the rich developed world. Right? And you can see that Singapore is an amplified, extreme version of the world economy. It's a call option on the world economy. Singapore is such an open economy with such a small domestic consumption base that consumers don't really figure too much in its ebbs and flows. It's a call option on global trade. But it amplifies the moves. That scale is -5 to +5, right? That scale is -17 to +17. Right? So if you're highly positive on world trade and economy, buy the dollar, buy Singapore economy, and you get an amplification, a leveraged option. If you're highly negative, get out, right? Because it's going to accelerate the drop. So that doesn't look good. And if we look at the Canary's core indicators on the next page, you can see the Canary is signaling that the gas is bad in the mine, right? Okay, and by the way, it's not really a Greek mine, it's a German mine, but I'll get on to that, right? Exports, investment spend, industrial production, all of those figures ticking down, and I'm sure when you get the October data, the December data, it's not going to look that much better. Financial services, unfortunately, we could only get 2Q11. I guarantee you that will go down when you get 3Q. For those of you in leveraged investment banking, prop trading stuff, corporate finance, all of those measures, activity and confidence are down. So the Canary signals things are not looking good. Next page. And my favorite lead indicator, which I always look at, which is the OECD data, also looks bad. Now, although I like the economic basis of the OECD lead indicator, it's a lead indicator that's not produced ahead, but is produced behind. Great lead indicator. That's the OECD for you. So it's always a couple of months behind. That means the latest we can get is August 11. It's likely for September and October to continue to look pretty nasty. So the writing on the wall doesn't look good. We should not be here. There was absolutely nothing in economic fundamentals, trade systems, and consumer behavior around the world to say that by this time this year, we would be here. Right? And economic fundamentals have not caused this. This has been caused by external and largely political events. So, next page. This is basically what's been going on. All of you are obsessed, as the press is, about the so-called Greek sovereign debt crisis. This is all absolute bullshit. Okay? That is a picture of global GDP. Now, if Italy started the year going down, or we had a sovereign debt crisis with the UK, which with the extreme austerity measures that they put in, some of us were worrying about, who are wet economists like me and against extreme austerity measures when you already have depressed consumption. If it was in one of the 3.5–4% of the world economy systems, then yes, we should be here, right? But you can see that the major engine, the US, was starting to show signs of life again. The Eurozone was chugging along perfectly happily at not very good growth, but not complete disaster either. China was absolutely fine, and in fact overheating. Do you remember the beginning of the year, all the talk was about inflation, precious, and how do we cool growth and too much flows of capital. And Japan was okay until it got hit by a natural disaster, but it was where Japan normally sits. The little number at the top there next to Singapore that I've labeled Muppets, that is Greece. Greece is less economically significant than South Africa. And who looks at South Africa every day? You don't wake up in the morning and say, oh, I better look at South African growth figures. Might influence my investment portfolio. It is even less significant, or about the same level of significance as the little red dot on the map that we are. We're a lead indicator, but we're not a sizable economy. Greece and what's been going on in Greece should not figure. Whether Greece is bust or not doesn't really matter. When Iceland went belly up, did it make much difference? No, not really. Even Ireland, which is a bigger economy, we didn't really notice too much. It's tough if you're Irish, and yes, it's tough if you're Greek, if Greece sinks, although they're great sailors, so they could all, get in a boat. But it shouldn't have made a difference, right? We are where we are because policy making, this is a mixture of appallingly bad policy making, bad economics, selfish politics, and in some cases gross incompetence. And the picture on the next page basically is what this is all about. Now, for those of you who know Macbeth, there are only 3 witches. Berlusconi deserves to be the 4th witch, but there aren't 4 witches, and he'd try seducing the other 3 witches, so I left him off. And he only recently joined, right? Does anybody know who the toad is down in the corner? Who started the whole thing? Being me, I have to have an American to bash somewhere, right? And the Americans deserve it, but we've all forgotten that Eric Cantor almost single-handedly, by allowing and driving the Republican House majority in Congress, of which he is the leader, to listen to the lunatic fringe on the Tea Party side and take the US that close to default, right? Or to not renewing the debt limit on US debt, which would have led to a dramatic downgrading, which was effectively some kind of default event. As it was, one rating agency, I forget which one it was, I think it was Moody's, did actually downgrade the US government, which is nuts, right? That all happened in the summer before the European idiots took over and took a bad situation and made it a lot worse. So that's why he's down at toad level. Now, I'm basically going to try and explain what has been going on here, why this was nothing to do with economic fundamentals, still isn't anything to do with economic fundamentals, and why I'm so worried, because it's a level of volatility and risk you can't control when you have 3 stupid people doing consistently stupid things. I'm going to start with the guy in the middle, not with Angela Merkel. Next one, on Jean-Claude Trichet. Now, thank the Lord, they managed to get rid of him by having him retire. He was due for retirement. Up until his retirement, he has caused a huge amount of damage. He has been most probably the sole reason why the Greece scenario has got out of control. Now, this looks a bit complicated. Let me just tell you what I'm getting at here. There are monetary and fiscal, right, partially fiscal, unions in existence already that happen to be about 300 million people and a roughly $14 to $15 trillion economic size. It's called the United States of America. It's called the United States because it's a federal union. It is a monetary union around a currency, the dollar. It is also a fiscal union, but it is not a strict, hard-line, guarantee all debts fiscal union. As you know, when California and Californians who tend to do stupid things with fiscal policy and spend and elect governors, well, you know who the governor is, who wouldn't know a budget if it dropped on his head. When states like that in the union get into fiscal trouble, okay, there is a resolution mechanism. That's what a monetary union is meant to be. It doesn't mean that the states, the Federation and the Fed of the United States guarantees California's debts, but there is a very clear insolvency process for union members and a resolution mechanism for in calcitrant states, and it works. I, on the radio this morning, just heard that a city called, I think it's called Birmingham, somewhere in Alabama, I think you might know which city, has just gone bust. It's just blown up. You've had a fiscal blowout that would be the equivalent of Greece. And I think it's to the tune of $5-6 billion. Not a small amount. And there is an insolvency process for wind up with a bit of federal aid, haircuts agreed with the creditors. The union works. The UK also works with their county states. Japan also works with their provinces. All of these things work. And the central banks in each of these countries, the Fed in the US, the Bank of England, the Japanese central bank, they all do what central banks are meant to do. They support their currency in sovereign debt. That doesn't mean they have to spend a lot of money, but by providing confidence and support and a clear message to the market, they don't have to dip into central bank reserves very often because the market knows the US dollar is supported by the central bank. The ECB doesn't do that for the euro. It's daft. Any stresses in your sovereign bond, they act as buyer of last resort. The Bank of England is the buyer of last resort of gilts, as is the Fed for the US Treasury stuff. And they immediately fix any liquidity problems by swamping the market with liquidity and sending a clear message to the markets. The debt levels and the debt to GDP and the current account deficits of the UK and the US are just as bad as Italy, and not that far off Greece. But we don't have a UK sovereign crisis, right, or a US sovereign crisis, because the ECB is not doing its role. And there has been a lot of rational people and economists clamoring for the ECB to step up to what it should have been. This is a fundamentally flawed institution, and Mr. Trichet has been the #1 guy holding that back. In 2009, September 2009, the IMF issued a report on the Greek fiscal position and basically pointed out at that time that there was absolutely no way in hell. So economists, we've known this for over 2 years, that the Greek state would ever be able to pay back its debts, looking at its cash flow and tax take, and that was when the Greek economy was not into complete depression after austerity, versus the interest payments that were required. 2009, September. It was muzzled by the ECB and Trichet, as well as the Germans. They stuck it under a seat and pretended it would go away because Trichet has this obsession, being one of the creators of the euro. No European state can be declared to be in a default state. That's not what the Eurozone's about. When we set up the Eurozone, we never imagined that. It's not allowed to happen, so we're not going to let it happen, so we're going to bury it and pretend it's not going to happen. And we'll just continue to weasel our way out of this and use a sort of a fudge. And of course, the whole thing spun out of control. The second side of this, next page, that has come out of the Trichet regime is monetary policy has been, quite frankly, a mistake twice over. Right? I don't need to remind people that this is the man that was still raising interest rates when all the signals on the green line, which is global growth, were already painting red. There was already a bank crisis from late 2007. Banks were starting to show the stresses of the mortgage books. Yes, Lehman Brothers collapsed a year later in September 2008, but the stress is already there. That guy was still raising rates, and he raised rates, only 2 months before Lehman collapsed, right? He did the same very recently. So he's so obsessed with fighting, yesterday's war. Like all Germans, he's obsessed with the Weimar Republic's hyperinflation years. He's always looking, oh my God, 2% inflation, which is a perfectly respectable rate of inflation, by the way. We got to start raising rates and do something to knock this out. By hawk standards, he's at the extreme end of, I don't know what is a bigger hawk, an eagle. Okay, and this was a mistake. So he's been piling austerity measures onto an already suppressed demand, weak Eurozone, at the time when you were starting to have these sovereign debt stresses, which, as I said, were caused by the fact that the European Central Bank is not a central bank. It's not doing what central banks are meant to do. So the whole euro system doesn't work. That's Trichet. Next page. Hang on, I want to have a quiz here. Flip back. Right. I'm going to do a quick quiz for you. This is a bit naughty, but since I've been told I'm eccentric, sorry, flick that in. we're going to have some fun. So this is one of those quizzes, things you sometimes do with kids. It's to see whether your eyes can track movement fast, right? So all the old men in the room, which is most of us, including me, you won't be able to get this. Right, I'm going to flick between those two. They're two maps of Europe. Right, who can tell me the difference? I'll go a bit slower. Anyone tell me the difference? Come on, simple quiz. Anyone get it? What's different? Or are you all colorblind? There's a trick. There's two colors here, basically, red and blue. And there's a bit of gray. Right, what's different? Slovakia's blue. Great. What else is different? God, did you do geography at school, you guys? Huh? Come on. Should all be... Okay, no, forget Rishi, colors. This is a color test. Okay, we got one thing that's blue that's red on the other map. Anything else? Spain is gray. Yes, that's correct. Any other... Holland, that's it. I knew there was some Dutch in here. Holland is blue, right? Sorry? Right, Norway. Hang on, I heard one thing. Norway is blue when it's red. That's it. Those are the only two differences in that picture. Right, does anyone know what the pictures are? Sorry? Global, World War II Europe, exactly. So, exactly. This is Europe 1942. German domination. I didn't put the title, right? I didn't put, honestly, I swear to God. It came like that off the internet, right? Google search, highly respectable source, right? This is Europe 1942, the reach of German domination. And, right, you can go back to, and this is Europe 2010, German domination, right? Right, so my next point is, all this squealing by Angela Merkel is daft, right? This listening to the German populace rather than going and explaining to them the extent to which Germany is the sole beneficiary, to a huge extent, of the Eurozone, that they would never have achieved if they had an increasingly expensive and high-priced Deutschmark relative to everybody else's currencies, and that they have achieved in a much cheaper, more efficient way, without panzers and aircraft and all that stuff, which is very expensive capital expenditure. I don't approve of that, right? As well as, you know, all that collateral damage of killing lots of people, which, as you know, for me, is also bad news because you're knocking out a lot of consumers, right? And I'm all about consumers. They've achieved exactly the same level of economic domination, right? All the red are extreme trade deficits with Germany. Right? Because of the euro, creation of the euro and the euro experiment. The only guys that don't have that and is Slovakia, God knows how they've managed to achieve that, and the Dutch, who are sort of out-Germaning the Germans for whatever reason. Right? The reason Norway and Russia have a trade surplus with Germany and don't suffer this extreme fiscal imbalance and pull out is oil and gas. That is the only reason, right? Germany, if you tot up the numbers, as I'm busy doing, have created trillions of value out of this. And if you hit the next thing, right? It's not, you people think, oh, Germany, they're following the China model. Their consumers are not consuming, which is absolutely correct. They're living off exports, doing a China, but China has an excuse. Its people are poor, they're a developing market. Germany has no excuse. It's not that they're selling Mercedes to, you know, people over here, right? It is to fellow Eurozone partners. Germany has a right and an obligation to keep the Eurozone going and not let Greece go down, because it was never about the Greeks. It doesn't matter whether the Greeks deserve it or don't deserve it, or fiddled their accounts and overspent and have half the population working for the state. That is irrelevant, because the size of the economy is a rounding error. It's because they would blow up the very system that has been benefiting them and allowed Germany to continue to post fabulous growth rates and keep an economy going that is not consuming and has too many consumers saving, not spending. And they're about to do that. The extraordinary thing is, rather than Merkel go out there, calm everybody down and say, look,
This is not about the Greeks. I know the Greeks don't deserve this, and it looks like we're spending good German taxpayers' money on those lazy Greeks lying in the sun, and why should we good, hard-working Germans do this? She sort of said, actually, we benefit from this far more than it costs us. And we've been benefiting for a long time, and you will have jobs because of Greeks buying Mercedes. By the way, they buy lots of Mercedes. And it's going to be a small rounding error, and if we don't do this, the whole Eurozone collapses, and the currency unravels, and it's going to cost us 20 times what the Greek bailout is going to cost. But she hasn't done that. The desire to preserve her fragile coalition politics have led her hand in hand with Trichet, who has this dinosaur model of prevent inflation at any cost and don't let anything, let's pretend nobody can default. Those two together have created this crisis, and you're about to see Italy almost go to the wall. And by the way, if Italy goes down, then France goes down, the whole Euro experiment is over. There's nothing to save. The Union will be Germany with Germany, and maybe Austria, and the Netherlands, right? In which case you just call it the Deutschmark, right? And you got back to where you started, and everybody else you call the drachma or the peso, right? So that is in essence what has been going on. Next page. Now, well, hang on. That's the so-called Euro crisis. Why do guys like me and the markets worry about this stuff and worry about the banks, and why have the banks been spiraling out of control? Now, it's really very simple. You know, I'm often incredibly critical of banks and the way they run themselves and the kind of stuff they buy and their proprietary activities and all their structured product nonsense. But this time, actually, it's not the bank's fault, right? Because banks hold sovereign bonds. They're meant to hold sovereign bonds. Sovereign bonds are called, set the risk-free rate, right? They're meant to be the risk-free benchmark yield instrument backed by the state, backed by the ECB, the buy of last resort, remember, providing unlimited liquidity, just like you get when you buy a gilt or when you buy a treasury, a US treasury, right? Banks are meant to hold this stuff, right? For the stuff they're not lending to consumers and businesses, so long as they're not doing other stupid stuff, which we all know they do, they're meant to buy sovereigns, right? So this is not the bank's fault if sovereign yields, and this is yields of some of the big countries, including, of course, Greece, that's Portugal, with that blowout rate there of over 1,000 basis points, Italy and Spain, right? When yields start blowing out, and of course, as you know, that means, firstly, the prices of the bonds go down. So if you're an Italian bank and you've loaded yourself up with Italian bonds, you're doing what you're meant to do, and it's meant to be the risk-free rate supported by the Eurozone, the ECB. Suddenly, the prices all go down because the yields get blown up because Merkel and Trichet together are doing stupid stuff and not taking action they could have taken 2 years ago to diffuse a crisis. And you have to market this stuff. Banks now are meant to sit there and say, okay, the price has gone down, we market to market. And if you market something that's gone down 5–10% for a bank, you've blown half your capital base out. So the European leaders and the appalling policy making and the fact that they've been going round and round in circles, turning what was a small molehill into a mountain and then into a full-blown crisis, they have single-handedly created financial crisis part 2. Right? It is genuinely not the bank's fault. And the real problem here is Italy. Those 3 numbers up there, this is why we're worried about Italy, where most banks in the world hold a lot of Italian debt. Not many of them hold too much Greek debt. So Greece is a sideshow. It should never have been the major focus. Italy is, I think, the 3rd or 4th largest debt market, sovereign debt market in the world. Number 1, right, is the US. And it's okay because they're a $15 trillion economy. They print the world's fiat currency we all use, the US dollars, so everybody buys US treasuries anyway, which is why they have a debt to GDP ratio of 90%, an appalling trade deficit, and yet we fund them at, what's the treasury rate now? Nothing, right? Whatever it is, it's a rounding error. 10-year money for the US government is merely priced at a couple of percent. That's how cheap it is. Even the UK government, with an appalling position for debt to GDP and trade deficit, we fund the UK government, we're happy to do that, and not that much different to the US. Whereas the Italians, We're now asking to pay about, I think it's 7.38% the last time I looked at it this morning. It's most probably spiraled up since. They can't afford that, but they're the world's third largest bond market. There is 2.2 trillion of this stuff out compared to 0.3 trillion of Greece. Who cares about 0.3 trillion? The Germans could write one single check for that. And what I've argued today is they should have written one single check for the entire thing 2 years ago and then quietly worked out how to get it paid back, and nobody would notice the difference. But you can't do that for the Italians, and the average maturity is only 7 years. The average maturity for the Greek stuff is at least 11 years. If you go afterwards and look at the average maturity of British debt, it's out at the 11, 12-year mark. We don't worry about it too much. The Italians are a problem, and that is why you should now be worried, because if Italy goes down, the whole thing is finished, right? All bets are off. You might as well sell all your holdings now, and if any of you are holding any euro, forget it, right? The whole thing will unravel. None of this needed to happen. This is all totally unnecessary. And the latest G20 meeting, they still haven't got their act together. That is why I charge these people with, I think they're either very stupid, right, or it is criminal negligence. For Trichet, who I know isn't stupid, it's criminal negligence. For Merkel, it's extreme political selfishness and a bit of incompetence. Eric Cantor, it's just plain incompetence. Right, next page. So we have a banking crisis, and the last page on that before we start looking at the real economies. I don't know, for any of you who know CDS spreads. CDS, just look at the blue line there. It is an instrument that protects you against default on bank's debt. Okay, so if you hold Barclays Bank debt or Royal Bank of Scotland debt, you can buy a protection instrument, think of it as an insurance, which is priced in thousands per, I think, 100,000 nominal of bonds. This is the peak at which it went to with the Lehman Brothers. You know, that was the complete meltdown in the banking markets, followed by early 2009. That was meant to be the extreme level of potential default of banks. But you're now looking at CDS spreads on European banks that are higher than the great financial crisis, right, which is extremely worrying. And all of this is because the ECB has done nothing to recapitalize these banks at the time they should have recapitalized them and provide enough liquidity to douse all this issue, let the sovereign thing blow out, and pretend. It was all pretense. They faked it. The bank stress tests, let me be very clear on the language I use, that the European Banking Association, at the behest of the ECB, overlooked by, guess who, the German Finance Ministry, was a complete fake. The stress tests didn't test anything that was stressful. It was a whitewash to try and pretend that European banks were okay. The French connived because they were, very, very scared to show any sign of weakness in French banks because they want to preserve their AAA rating. So that July stress test was complete garbage. Anyone who, like me, has been in the business of stress testing banks for most of their life knew and said it was nonsense. Dexia, for example, got the number 10 ranking in all European banks, and then 3 months later, Dexia was bankrupt. So that's the bank crisis. Now, next page. For those of you who continue to hold bank stock, I despite many years of talking about the dangers of investing in banks during potential stress on their balance sheet crisis times, I still get lots and lots of quite smart, ordinary investors in this room who continue to believe that they should invest in banks. And they continue to do funny things like look at bank P&Ls rather than bank balance sheets. Right? So obviously I don't get the message in their head because the bank's P&L and whether Citibank is making, so many billion of profit this quarter or not is completely irrelevant. Right? Their balance sheet businesses, you only look at the balance sheet, and the only thing that counts is capital and the stresses on that capital, because merely an 8% blowout on a major chunk of assets somewhere can wipe out their capital base. Banks are leveraged call options. They're highly dangerous. When they're good, they're fabulous. In good times, they shoot up, like all leveraged call options. In bad times, they shoot down. This is now out of date because when we got the data, which is JP Morgan data that was in the FT, which was about a month ago, in the height of the Greek, which, as I've said, is almost a sideshow crisis before what's happened with Italy, right? That was the level of sovereign, basically, haircut needed, the capital position of the banks, and the level of capital depletion against their capital caused by sovereign debt, largely from Greece and Portugal and Ireland, the weak ones, before you factor in Italy. And remember, all these banks have huge holdings of Italy. If you redid these numbers now, I reckon you've wiped out all the capital of KBC, Commerzbank, UniCredit. Barclays would be getting pretty close to wipe out, because I know they hold a lot of Italian debt. SG is most probably fairly close, and Deutsche is getting up to the 80% level, okay? If you mark to market their current position. Now, I'm not saying that Italy they're going to, I hope, now see sense and let Italy blow out. But for those of you holding bank equity, continuing to believe in this bank recovery story and bank prices are cheap, never forget they're cheap for a reason. By the way, we've had a couple of dead bodies already, right? And the nice thing about Dexia was fundamentally flawed from the start. The nice thing about MF Global, John Corzine nicely illustrates the fact that investment bankers continue to not have a clue, but unlike most people who aren't too smart, think that they're really smart and they know what they're doing. Because he's a former Goldman Sachs guy, he, like all Goldman Sachs guys, thinks, you know, I know what I'm doing and I'm a really smart guy. And he took a huge position in Greece, Italy, Portugal, Spanish Eurobonds, saying, oh, it's the Eurozone, and they'll never let the whole thing go down. So they'll step in and provide unlimited liquidity, unlimited support, be the buyer of last resort. All the things I told you the ECB should do. He made a bet they would do that, right? But those of us been watching Trichet and the ECB have known that Trichet has always resisted doing what he wants to do and say, no, the ECB is only going to sit there in its little hole just doing monetary policy and interest rates and being the hawkish watchdog on inflation, right? So he loaded up MF Global to the tune of, I don't know, 10 times the capital of the thing. And of course, the whole thing has collapsed and he's blown up MF Global. That's, you know, a great Goldman Sachs banker for you. So these things remain dangerous. And this was all on a proprietary book, and even worse, using some clients' money. What a great guy. Just to remind you, right, this comes back from those of you who remember when I was presenting to you guys around early in the great financial crisis in 2009, right? And I put this page up then and I said, let this be a lesson to you, right? This is what can happen to banks. When banks look cheap, and a lot of you were buying them, when I said don't, late 2007, right? This is what happened to the stuff you bought. And I thought those of you who lost a load of money then holding blue chip bank names, by the way, including certain sovereign wealth funds in a certain country whose former parliament I now stand in, right? That was a smart decision. This is what happens, lesson learned. And I still see investors piling in to cheap bank equity, right? So that is it for the Eurozone crisis. This is the key thing I wanted to talk about today, right? Because this is what everyone wants to know about. That's why I haven't started off with the usual data on, you know, the US and then the Eurozone and key economic indicators. Key economic indicators and economic fundamentals mean nothing when you have policy making and things like that going on in the Eurozone. Then, you know, it doesn't really matter. But for what it's worth, we'll just do a quick summary, as we normally do, on where is rational fundamental economic data. And as I have always maintained since end of last year and beginning of this year, the US will not go into a double-dip recession. There's no need for it to go into a double-dip recession unless the world is blown up now by an Italy collapse. And recovery was on the cards and is still there. Now, that doesn't mean recovery is particularly strong. Retail sales plus 3.8%, that's not great. But it does say the consumer who is still saving, not spending, is now starting to get out of bed. Slowly. It's largely jobless. It doesn't feel very nice in the US. But it's a difference between something that feels like a recession but is actually some small positive growth and a proper double dip. And this is not a double dip, right? Business confidence is up a bit, inventory picture's all right, industrial production's flat, but it's not declining. Manufacturing has taken a dip because of this sort of euro crisis, but it's not too heavy. Corporate earnings are not as good as they should be, but it's not a complete collapse. Business spending is okay. But the most important thing for me is up there on retail sales. Consumer confidence has taken a knock purely because every day, even an American has now discovered where Greece is, and they're reading in their newspapers, oh my God, Eurozone crisis, right? Next page. Let's, remember I'm always obsessed by consumption. I'm a consumption economist. They're still saving, not spending. And I've always argued that's not a bad thing, while they pay down debt, restore the household balance sheet so they can start spending again. But notice recently you've seen a little, having built their savings rate back up to a comfortable level of about 5%, which is quite frankly where it should be and where I'd like to see it, they've started to spend down on some of that. Next page. And be out there, the only thing still holding them back, which remains my core measure, is housing is still in funk. That is still the primary source of household wealth and balance sheet for the household. And we're still down. Blue is starts, green is actual sales. Average, this is my long-run data going back to 1963. Remember the whole Cuban Missile Crisis thing I always say, and the gloomy month I was born. We're looking at an average that is 60 and 25,000 a month for those two critical pieces of data. Half what the 48-year average is until that figure turns, and I always tell you this, watch this data. When that starts turning, the US is back. Now, I'm not a technical chartist. For those of you who are, I would call that a consolidation at the bottom pattern. That's my reading of the charts, and my review of a lot of other data. I think this is consolidation at the bottom. Yes, there's still a big foreclosure overhang. There's a lot of people with negative equity, but it is a lot less than it used to be. It's slowly being cleared. It will continue to consolidate along the bottom for a little bit, and then it will slowly start moving up, and then you're through the woods. The US is slowly, painfully recovering. Next. Which, by the way, I think makes US equities relatively cheap. I have always maintained, if you remember my original filecasts, I'm just putting them up here, that the employment picture will look grim for a long time, and it is a minimum 5, maximum 8-year recovery cycle after you've had a deep recession for employment. And it was the same with the deep 1981 recession. And it was not too far off that for the deep 1991 recession. And this was a worse recession because it was a financial crisis, not a normal cyclical economic crisis. Why do people think that you're suddenly going to get a snapback in employment, merely 2 or 3 years later, right? You're going to stick around at 9% for a long time. What's important is it's not continuing to go up to 11%, right? It is stabilized, and it will, I'm afraid, be 2015 at least to 2017 before you clear it. Next. Put the data up. Everyone's talking about double dip. This doesn't look to me like a double dip, right? Middle class stuff, some of the working class stuff, limited brands is sort of luxury stuff, lingerie and all that kind of stuff. There's nothing there that makes me, unduly worried. Next page. Tech is doing fantastically well, right? What is there to say that this is a double dip recession scenario, and without the Muppets in Europe, this would be even better, right? Look at, by the way, Cisco is a bellwether. I have a couple of things, I always keep an eye on. I have US housing starts and sales as a screensaver, the single key piece of data on the planet for me. The second thing you want to look at is Cisco. You monitor Cisco, that's the bellwether on corporate tech spend. Next, we have Cisco stuff ourselves, right? Manufacturing, right? Autos, a key measure. Look at the automakers. Show me the double dip recession, please, right? This is a European idiocy thing, not the US is not recovering. Next. The fact that these guys are not hiring more people and they're putting it in their pockets and increasing corporate profits, I can't control that. Eventually they will hire more people and unemployment will go down. In the meantime, if you hold US blue chip equities, right, hold on to them. And if you haven't bought some because they're reasonable. Eurozone, on the other hand, I'm sorry, but it's too late. They were almost at stall speed before, and this is going to be a recession. Look at consumer confidence, look at retail sales here. Okay, and this is before the latest stuff, right? That's back in August. Look at business confidence, look at corporate earnings. The only thing that's held up is industrial production and manufacturing. And guess where those figures come from? If you dig down into those figures, it's not everybody's industrial production and manufacturing, it's Germany's, right? That's it. Right? So you're looking at a Eurozone recession, totally self-created, but continued, slow, painful, largely jobless US recovery. I put my bets on the US. I don't touch the euro. I haven't been anywhere near this place for at least 2 years now. China, I've always argued that this would be a soft landing. The data speaks for itself. All of the talk that, oh my God, you know, the PMI's just tipped down in China and the whole thing's going to unravel and the last engine of growth is good, that's all nonsense. China has sufficient firepower on its balance sheet, sufficient foreign currency reserves, sufficient leeway in its fiscal position, and a wall of domestic savings to engineer a soft slowdown. What's been going on in housing in China, which everyone gets nervous about, the government wants it that way, just as the government in Singapore wanted to engineer a soft landing for domestic residential housing. It needed to be brought down, and they have brought it down, and they're going to keep it cooled down for a bit. Exports are still storming ahead, manufacturing is still good, corporate earnings are zipping along. All of this you expect in China because they built their economy around corporate investment in industrial production. But look at this, right? That's the best number I've seen for a long time. That gives me huge cheer because I'm one of those guys banging on for years, as we do with the Germans, get your consumers out there spending, not saving, right? And let's get a bit of retail action going in all those shopping malls that you're building with lots and lots of concrete, and that is now happening. Next. And the final thing on the global economy and the positioning of where you've got to look out for investors. So if China's a soft landing, where do we go on monetary policy? Now, this has blindsided most of you. How many of you around the room thought that the yield curve, right, on everywhere from the US to the UK, this is out in December last year. Do you remember when I spoke then? This is June this year, this is January this year when we last spoke. It shifted down that way. Money is even cheaper. Yet, hang on a minute, weren't we all worrying about inflation and bonds going down? Remember, when inflation goes up, you know, that causes yields to go up, bond prices to go down, a bond crisis. Bill Gross, who's meant to be the smartest, most powerful, he runs the largest bond fund in the world, so he's meant to be the smartest bond guy in the world, right? He made a huge bet with PIMCO and their huge bond fund that the curves were going to shift out that way, right? Because a little bit of growth was back and there would be creeping inflation. We all had inflation problems. And of course, you know, he's got it wrong and it's gone the other way. You are going to continue to see easy money for a long time. And the Europeans have just added to that. Nobody can take any chances with this recovery. And though, as I've said, I believe in a slow US recovery that's the engine for the rest of the world, and I think the developed markets will continue to tick along nicely, it will have to be continually fed by easy money policy. All our bets in our house are on continued easy rates. We've just done a round of refinancing, and we've taken variable rates. We haven't taken fixed rates, right? Because we think things will continue to be easy. So that's monetary policy. Right, the last 5 minutes, and then I want to keep a good half hour for Q&A. So we're now just past 5. I'm going to finish at 6, but what I like to do is finish in 10, 15 minutes, and then 10 minutes, and then we have lots of questions. I thought I'd talk a little bit about, sorry, just go up a bit, investment, right? And, you know, what guys like the Fry Group and so on are meant to do. And I have to say, I'm often can be quite rude sometimes around the behavior of investors and the stuff you invest in and your timing and the fact that you tend to buy when it's too high and sell when it's too low and do all the wrong things. But again, like the banks, this time, I'm going to be very nice. It's not your fault, right? This market this year has been completely irrational. And there are a number of things I've been thinking about in terms of the modern investment theory that all of you are following that I think are fundamentally wrong or very questionable, that there's now definitive proof, right? Let's put up the first one. You all know I grew up, like all of you, with efficient market hypothesis. So I was even taught by Jack Broyles, who was one of the efficient market capital asset pricing theory guru guys. And for years and years, I actually believed all that nonsense. That, markets are perfect and they factored in all information and you have the risk-free rate and a bit of volatility measure and yeehaw, off you go, and you can build nice models for everything and have efficient frontiers and so on. All complete nonsense, right? It doesn't work anymore. Markets have fundamentally changed. If you look at the economic data and the fundamental data on companies and where it's been going for this year, and you track it to these kinds of movements, there is nothing efficient in what has been going on in the markets with such extreme movements up and then such extreme movements down in the space of 2 or 3 months with zero change in the underlying economic fundamentals. In fact, retail sales improved, consumption improved, manufacturing improved, inventory position improved in the US, unemployment for the first time showed signs of ticking down, and the depressed house market stabilized during the period from August to November when the US market basically collapsed. Okay? Everything was getting better and the market went down. And the US dollar, right, which was strengthening, suddenly took a complete bath the other way. So the weakening of the dollar suddenly became strengthening purely because of risk aversion, play nothing to do with the fundamental strength of the dollar. Next page, you got similar moves in commodities markets. I mean, what's this all about, right? Gold was moving up, which was correct at the beginning of the year because it's meant to be an inflation hedge. So if you worry about inflation, okay, you buy gold, right? Then when the inflation risk, looked as if it was sort of going in reverse, it ticked down a little bit and then it just fell off a cliff, right? This is meant to be a risk aversion measure, and as extreme risk off came here, gold should have been the thing rising. Instead, it collapsed. If gold, the whole point of gold is it's not meant to be correlated with any of these other risk financial assets. It's meant to do its own thing, but it wasn't. It was following the markets. Silver has been all over the place. There's no way you could have rationally predicted in any model the direction of silver. And of course, as I said, what happened with rates, which leads to treasury bill rates, has been completely irrational for the year and unpredicted by anybody, including Bill Gross himself. So, next. Hedge funds, which is what you're meant to turn to as investors. So if you have this kind of level of irrationality as ordinary investors and you can't predict yourself, what do? I guess you either turn to the Fry Group or you turn to hedge funds, right? Hedge funds are meant to hedge, okay? That's where the name comes from. That's hedge fund performance for the year, right? I mean, even at their best, they were only doing 1.5% monthly movements up, right, before everything. And then this is what they've been doing since. So hedge funds are as correlated as every other asset in the world. They do not hedge. They're another correlated asset class, as correlated as gold, that isn't meant to be correlated, as correlated as bonds, which are not meant to be correlated with equities. It's all either risk on or risk off. Everything has become correlated to lunacy, okay? How you invest in this market, I have no idea, right? If you're market investors. I do okay. We still make 25, 30% a year because we invest in real assets and real companies and private equity, so we don't have this problem. But I don't understand how investors can invest rationally, and the efficient market hypothesis definitely doesn't work, and standard portfolio construction. By the way, this guy down here, this is Paulson, for those of you who don't know. This is the guy everybody said, oh, he's the smartest guy and the best hedge fund manager in the world, and he's the guy that got it right and made the bet against the US mortgage market. And when the great financial crisis came and all the banks sunk and all the subprime mortgages went down, he was making billions. The same guy, the super smart guy, right? So, of course, what everybody does is they all go and give him billions and billions of dollars, and his hedge funds, Advantage Plus Recovery, became some of the biggest hedge funds in the world. And look at their performance now. Now, remember, that's pensioners' money and all these kinds of things, right? That's not sort of ordinary men in the street. So hedge funds are not working either. Next page. And the final thing, now this, I apologize, this is a picture I cut out of the paper. It was so good, we didn't have time to reproduce the data, which comes from Bloomberg. But I want you to look at this carefully. For all of you who are normal, rational, sensible equity investors, you invest for the long run, and you give your money in nice wrap accounts, and you expect to see equities outperforming bonds, which outperform cash, and all this kind of stuff, right? And you believe in all those old efficient market CAPM models that we all grew up on. And this is volatility, quarter by quarter volatility. So these are 13-week blocks in every year, measuring volatility in percentage, such that in any 13-week period, suppose the market went up every single day of every single week for 13 weeks in a straight line, the number would be zero, volatility is zero. Or if it went down in a straight line, okay? And any movement any which way then gets measured as the difference of where it starts to where it goes. Now, you can see back in the 50s and 60s, right up into the 80s, other than a spike, okay, down there, which was the Black October crash, for those of you who are around who remember that,